Hi guys, welcome back to the channel. I wanted to talk to you guys a little bit about why buying the dip in 2022 has felt so very bad. And principally the reason why it's felt bad is because the market has kind of sucked this year. Um, every time you turn around, it's setting a new low, right? And it's been doing that consistently for 6 months. Um, and that's just the way the market is. We're kind of in a bear cycle right now. The bears go out and they win. Um, and so buying the dip has felt sort of like this. Oh, the market is down. I'm going to buy some. And it goes down. And oh, the market is down. I'm going to go buy some. And it's down. Oh, I'm going to buy some. And it's down. And depending on what stocks you're in, you could have been obliterated, right? There are some stocks that are down 90% from their all-time highs, which was just back in November. So 6, 7, 8 months ago. So really, you could have had a really rough time this year. And buying the dip just wasn't working for you. And I want to talk about why that didn't work. Why buying the dip was so unsuccessful this year. And I think that the number one reason is that we were in a huge speculative bubble. Had we not been in that big speculative bubble, I don't think that the market would have fallen nearly as much as it has so far. And it wouldn't be buy the dip, buy the dip, buy the dip, and down, 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 right? What would have happened is we would have bought the dip, and it may have been flat, but eventually would have started coming back up. That's what we've sort of always experienced for the past 10 years or so. And a lot of people have been brought into the market sort of assuming that, oh yeah, you just buy the dip because that's what's worked for a decade. And they started pushing up valuations and up and up and up. And it's not everybody's fault, right? The Federal Reserve made interest rates super cheap. And so, institutional investors are looking at that and go, oh, hey, maybe we should push down our discount rates and thus push up our valuations. And now the Fed is sort of fighting against you. And the price of things started coming down because, oh, hey, I can go get a bond for 3% these days or what have you, basically risk-free. And so maybe I should start bringing my discount rates up, and that brings valuations down and all that sort of stuff. And so it hasn't been really fun for dip buyers this time. The Federal Reserve hasn't really been our friend in terms of buying the dip. But I've been very, very comfortable buying this dip over the last couple of months. Matter of fact, I'm more excited to buy today than I was 6 months ago. Right? 6 months ago, I felt very, very cautious. There were only a handful of things that I felt very comfortable investing in. And now I'm still very cautious, but at least I feel like things have come down to fair value. Up until recently, everything's sort of been sky high, and a lot of things still are sky high, frankly. But a lot of things have started moving towards their fair values, and the gap between the price and the fair value has shrunk a lot. And that's made everything more attractive. I'm very comfortable buying with my valuation metrics that I've come up with, principally a discounted free cash flow model. And if those things keep going in the direction that I want them to, there's going to be a lot more opportunities to buy. Currently, I'm buying left, right, and center. I think that it's a great time to buy as long as you understand what you're buying, you understand the business model of what you're buying, you understand the uh, the valuation of what you're buying and what that implies for your future earnings, but for your what that valuation implies for your expected rate of return on the investment. And if you're comfortable with that rate of return, then that's great. It's fantastic how it is right now. Um, but I think that sort of highlights the reason why buying the dip has felt so bad over the past couple of months is that people just don't understand what it is that they're buying. They don't understand why they're buying what they're buying. They don't understand the story behind the company. They don't understand the valuation that they're assigning. They don't understand the assumptions. They don't understand the risks that they're assuming. And because they don't understand any of that stuff, what ends up happening is the price declines. They buy and they don't realize that the price is declining and it's going to continue declining because fair value is $10 and they're paying $40, right? And if you're doing that, you're going to lose money. It's just the way that it is. You will lose your money. You will lose your shirt if you keep buying and investing like that, right? And you can keep buying the dip and buying the dip and buying the dip. But if you're paying way more than fair value, you're going to get crushed in the market like this, where you have high inflation, you have high interest rates, and you have a Fed that's raising interest rates. The name of the game in this kind of environment is not growth, right? In this kind of environment, the name of the game is cash flow. Now, that doesn't mean that growth isn't important. It just means that the growth is less valuable today than it was yesterday. And I think a lot of people have missed that fact, right? They've missed the idea that everybody's been buying tech stocks and growth at all costs, essentially. And yes, I want to grow, but I don't want to overpay for that growth. And the problem with that is that if you overpay for that growth in this kind of environment, interest rates are going to rise on you, and that growth is going to become less valuable, and it's going to start, the valuations are going to fall, your P's are going to fall, all of your metrics all of your price related metrics are going to fall. All of those things are going to start coming down, and they're going to crash down around you. And that's the name of the game in this kind of environment. I'm not saying don't buy the dip. I'm saying understand what you're buying. Make sure that there's cash flow to support what you're buying, right? That's the important thing here, is that you need to understand that cash flow is the name of the game in this environment. Cash today. That's what you want, is you want cash right now, because that is what that's what inflation tells you that you should want. That's what the interest rate is telling you what you want, and that's what the Fed is telling you that's telling the market right now. And the Fed is telling the market, hey, buckle up, you want even more cash today than you did yesterday, and even more than you wanted 6 months ago, right? Growth, if you have to wait 2-3 years at a 9% inflation rate, 9% headline inflation rate to get your cash back, you have to wait 2 years. That is just, I don't have the numbers on the top of my head, something like a 20% loss compounded. It's not great. right? That money is not worth nearly as much to you 2 years from now, which is what growth does, right? Rising inflation rates are just going to crush your valuations. You're what I don't think people understand is that it's like you have a big stone tied around your neck, right? And it's just dragging you down. Um, that's just what the valuations imply at the moment. And that's why buying the dip kind of hurts right now. Now, shifting gears a little bit, if you understand the valuations and you've made very conservative valuations and you're using very conservative discount rates and growth rates and so on and so forth, and you have a large margin of safety and the price that you're paying per share, let's say, use very conservative growth rates, you've used very conservative discount rates, you're expecting, easily 15% returns based off of your model. And then on top of that, you're getting a 30% discount to that. Buying the dip doesn't seem so bad. You're getting a great, great, great price for this asset. And could it fall some more? Yes. Yes, it can, right? Just because your model says that it's worth $10 a share and it's trading at $5 a share doesn't mean that it can't go to $4 a share. It doesn't mean that it can't go to $3 a share. Matter of fact, that very well could happen to you and it would feel horrible, right? It would just feel awful. And you would want to keep your eye on that. And so a couple of things that I would suggest is do discounted cash flow models. Understand what the valuation of your companies are at the moment right now. Does it make sense to continue to put money into this business? The number two thing that you want to do is you want to look at the return on invested capital. That's A to number two. And B to number two is you want to look at the returns on incremental invested capital. Those two things are very different. I'll probably do a video on those later, but that's the idea here is that if you're putting more money into this business, what you want to know is what's the business going to do with that money? Now, obviously, you're buying on a secondary market. It might not go into the hands of the company, blah, 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 right? I get that. But the point is that I look at it from the perspective of, should I put more money into this company today? If I could just buy directly from the shares, directly from the company, would I do that? Right? That's what I do. That's the way I look at it. And if for example, this company has an annualized return on incremental invested capital of say 15%, and they're cash flow positive, I'm probably going to do that, right? That's just the way that it works. And if it makes sense to have those valuations, if it makes sense with those valuations to do that sort of investment and it's dipping, it's probably a good idea to buy some more, right? And that's the way that I roll when I'm trying to invest, is I'm trying to find a good investment at today's prices and understand what I'm getting myself into. Right? I'm trying to understand what the correct price of this stock should be. All right. Peace out, guys. That's all I've got. Talk to you later. Bye.